Hello, everybody. How we all doing today? Let me adjust my camera. There we go. That's a little bit better. Can everybody hear me okay? Everybody see me and hear me okay? Wonderful. Awesome. All right, guys. Uh, you know, there a lot of talk right after the close yesterday about this new AI infrastructure bill that the market obviously likes a lot. So the market rallying today. We'll see if it holds. We have not seen a real consistent pattern over the last several months with market moves. It's really been a lot of back and forth. But for right now, pretty bullish. Our position, excuse me, we were positioned appropriately for this, which is a good thing. Dow's up 100 points. The 10-year yield. Okay, this is a big one. 10-year yield is actually up today. Yesterday was down significantly, and it's been down significantly since it topped out last week around 480. Went down to about 457. It's at 461 today. And that's because there's a lot of uncertainty now on the tariff situation. Um, and, if that does come to fruition, that probably is going to put a big hurt on inflation. Inflation's going to tick up. So rates ticking back up today, but it's what we have seen the pattern is when rates are going down, the 10-year is going down, we've seen the markets go up, and vice versa. As when the 10-year yield has increased, the equity markets have gone down. We're not seeing that today. So we'll have to see what happens here. S&Ps are literally just a hair off of their all-time high. They're up 46 points right now. So let's see. All right. But what I want to really talk about today, because this was a position that we had on, okay, and we talk about calendars all the time. But I want to talk about a calendar spread strategy, which is specific for an earnings play. We'll go into another time. Okay. We'll go into another time when we do other calendar positions like what we have on and a couple other positions right now that were not specific for earnings. Ah, thanks, Jake. You like my Snoopy there. But it is definitely different for earnings. Okay. Can everybody see the presentation on the board here with my calendar and all that good stuff up there? All right. Great. Let's get at it. Okay. So first, we're going to review real quickly what a calendar spread is. Okay. And how it works. Okay. A calendar spread is literally just using, excuse me, the same strike option, but buying time or selling time. So two different expiration dates. Okay. Whether it's a day apart, a week apart, a month apart, whatever it is, two different expiration dates, same strike. Okay. A diagonal, two different expiration dates, different strikes. Calendar, same strikes. You can have call, you can have put. Okay. Now, the reason why in here we only buy them, okay, we don't sell calendar or diagonal spreads. We don't sell that time, even though it can be a very, very effective type of strategy. Okay. The reason we don't is because it takes up a massive amount of capital, a massive amount of buying power. When you buy time, when you buy a calendar, your maximum potential risk is fixed. You know what it is. It's whatever you pay for that time. Okay. But when you sell time, when you sell that calendar, if I were to buy this week and sell next week or a month out or whatever it is, the way that your brokerage firm treats and looks at that spread is what's going to happen when your long option expires. You're going to be left with a short option, whether it's call or put. Well, if you have a naked short option in your position, you've got a massive amount of capital used out, a massive amount of margin or buying power. Okay. So that is exactly why we don't sell them. Okay. Everybody understand that. Even though that can be a very, very effective strategy. That is why we don't sell them. Okay. Now let's go through this few things here. Okay. As I just said, a long calendar is this scenario right here. Selling something that expires before the option that you have bought. Again, whether it's a day, a week, a month, 6 months, whatever it is. Okay. A short, which as you can see here is less common because most retail traders don't trade short calendars or short time spreads because of that capital requirement, is just the opposite. Okay. Now, on a long calendar spread, like I just said, we know what our maximum loss is. It's whatever we pay. So, for instance, in the Netflix position we did yesterday, which happened to be a long calendar put spread and a long calendar call spread, we paid, I think, $2.40. That thing could go to zero. Okay, that thing could go to zero. That's our max risk. However, we don't know, there is no way to calculate what your potential profit could be because of the differing expiration dates. Okay, because let's say Netflix exploded, we had the 1000 calendar, right? We did really, really well on it. But what if we just let it go? Okay, stock closes this Friday 980, right? 990, 970, whatever it is. And the short expires worthless and we're just left with a long call because we didn't close it out. Well, now you have a naked long call. You don't know what that could go to. It could go to zero, it could go to infinity. So we never know what that potential profit is. However, we do know what the maximum loss potentially is, which is why we know that we can size our positions appropriately. Okay. Now, on our reward to risk spreadsheet, which you all should have, showing what we look for in our reward to risk, typically we look for a double. Okay, typically we want to see, if we paid $2, we'd like to make $2. Okay, and we do that by looking at the P&L graph when we put the position on, because we can look at that at the short expiration. So we can look to see what the value of the position is at the short expiration, but not beyond that. Okay, now, what is the best thing to happen in a calendar spread? What do we always talk about? We always want to go to the short strike. Does not matter what the type of position is. Okay, so if you look in these two things to remember here when it comes to calendar spreads, if the stock moves too far away from the strikes, whether it's below or above, that's a bad thing for the position. Another thing, though, with a long calendar spread, since we are buying time, which means we are buying Vega, and that's something that we discussed this, I think, last week or 2 weeks ago, the whole Vega scenario on which options strike wise, expiration wise, has more volatility risk. The further you go out in time, the more volatility risk there is. So typically, an increase in implied volatility is going to help the position. But when we do a position, when we put on a calendar spread specific for earnings, we know the vol is not going up. We're not putting the position on for the vol to move up. What we are doing is looking for the vol to normalize. And that's something that we have to calculate. So let's go through this scenario here in what we did in Netflix. Okay. Here was a stock chart in Netflix going into the trade yesterday. Okay. You look at this here, and yeah, overall, this is definitely a bullish type of trade setup. This chart is very bullish. Lower low or higher lows, higher highs. But you go into earnings, you never know. So rather than just play the bullish side, we did both. Okay. And we did both because of the difference in implied volatility. Now, on this screen, we're going to see, or what you see here, is the range, the changes in implied volatility in Netflix. We can see, up, up, down, down, up, down, pretty much coinciding with earnings. And this is really, really relevant around earnings because we know, we know with 100% certainty that vol is not going to stay up here, right? Once the news is out, regardless of what the stock does, whatever the stock does, we know that vol is going to come crashing down. Hey, Zora, how you doing? A very slow day in trading? Really? We were breathless for the first 60, 75 minutes in the room here today. So I'm not sure, I'm not sure what you're really talking about there, but we were nonstop. Anyway, going back here. We know that IV crush, as Jake Jacobson just talked about. Or no, who said that? What's your option? Okay. We know that's going to happen. We have to calculate that and figure that out. So, how do we put on a calendar spread? How do we know the right strikes, especially for earnings? Well, just like any other thing, any other position, we got to figure out the expected move. Okay. Now, when we put this on yesterday in Netflix, the stock right here was about 870. So, what do? We look at the 870 calls and puts here, and we can see roughly a $72 expected move. Okay, does everybody see that? Okay. Well, based on that expected move yesterday, if we would have targeted just the strikes from the expected range, with the stock trading 870, we would have been right around 800 to 940. Okay, does everybody understand that? All I did was take a $72 move approximately based on where the stock was, gave us 800 basically to 940. But those aren't the strikes that we used. Okay, those are not the strikes we used. And that is because typically for an earnings calendar, I like to typically look beyond that in case there is a bigger than expected move. So I typically look at strikes that are 3 to 5% or so beyond the expected move, which is how I came up with yesterday the 750 strike put rather than the 800 or whatever it would have been. The 1000 strike call rather than the 940 or 950 strike call. But what else do we have to do here? Because we know there's going to be this massive crush. When I laid this out on my P&L graph expectation yesterday, okay, I put those implied vol adjustments in there. You have to do that if you're trading around earnings. If it's not around earnings, fine. Don't worry about it so much. So you can see on the short 750 put, I reduced my implied vol from the 116 it was trading at down to 65. On the short 1000 strike call, I reduced it even a little bit more. 127 down to 60. Now, when it comes to these adjustments you're making, when you're calculating or looking at a graph that shows the potential P&L, it is more important on what you do to your long option than what you do to your short option. So on our long option, I went to 36% on the put. I went to 35% on the call. Whoops. Don't want that. Let's see where that's actually trading live right now. Okay, let's see where that's actually trading live. Okay, this is the reason why, or one of the reason why, our position worked out so well. Okay, now we can look on the put side, and it doesn't really matter what adjustment we made because the puts are zero. So it doesn't matter if you run a 50, 70, 90, 150 vol, not going to matter. Okay, on the call side, I had run our short at a 60. It's now trading 49. That's a good thing. It moved further than what I calculated. On our long call, I had put in a 35 vol. It's trading 32. Okay. So you can see that adjustment that I used. I overstated the adjustment on our long. I understated it on our short. Let's get this back in here now. And before we go any further, hey, I'm only going to do this for one day. I know we talked about this yesterday that I was going to move away from Groucho a little bit. We suggested using Harpo, one of the Marx brothers. Okay. So this is Harpo. He's only going to be up here for one day. And Harpo never speaks, but his word of the day is calendar. All right. We got to come up with a different word of the day system here, but today it's Harpo. Leave this up here for a moment. We'll come back to that. Okay. So this is what I was talking about. We must remember to adjust our implied volatility to where we believe it's going to be trading post earnings. Otherwise, not going to get an accurate potential P&L graph. We have gone through before what I believe those adjustments should be. We can review them again at another time. Okay, but these were the adjustments that I made here. Now, this graph right here, this depicts basically the graph of any kind of position where the max profit would be. That max profit on here, and this was just a generic chart down at the bottom here, but this max profit would have either been at 750 or 1000, the two strikes. And the further away from either side, okay, the further away from either side, the worse the position gets. Now, did we get lucky? Was it just we used the right strikes? What was it with Netflix? We used the 1000 strike. That stock traded to 998. Now, when we opened today and we got out on our first tranche of exits, I think stock was trading like 985. Stayed there for a long time. We got out of the balance down at 965 or 970, whatever it was. But that is always where, when you graph something, your max profit is going to be at the short strike at expiration. Does everybody understand that? Does everybody follow that? Awesome. Okay. So, kind of summing up calendar spreads. And again, today we were only focused on calendars, and really it's the same for diagonals, but we just did calendars around an earnings trade where we know there's going to be a massive, massive change in implied volatility. Okay. So a calendar spread is a risk averse strategy. It's one of the most risk averse strategies that's out there, especially when you're on the long side of it. When you're on the buy side of it, you know exactly what your max potential loss is going to be. Sell an option that expires closer than the one you're buying. They do not use up a lot of buying power. If you compare whatever platform you're on, if you compare how much capital you're using up between calendar to whatever other strategy, you are going to see that it does not use a lot of capital, which is why they are also great for IRA trades. Okay, again, calendars, same strike, different expirations. Now, a calendar allows us to make an assumption on direction. Okay, in the Netflix one, because we had no idea about direction, we were playing for it to move in either direction. We could care less for the position if it went down to 750 or up to 1000. Those were our targets. What we didn't want is the stock to stand still at 870, 880, wherever it was. However, you can also put on a calendar spread if you don't think a stock is going to move. Just like when we believe a stock is going to be very range bound and we put on an iron condor, we put that on because we're selling premium, but we do that when vol gets really high. Calendar spread using an at the money. So in the case of Netflix, whether we had used 860, 70, 80, whatever it was, if we had done that calendar spread, that's a very neutral position where you are looking for the stock not to move. So you can use calendars to be bullish, to be bearish, to be neutral. Okay. And as I put in there right there, again, we reviewed this specific to earnings. Calendar spreads are unbelievable positions, strategies to have on in a low volatility environment, because you get to take advantage of the theta from your short option while your long option holds its value because the vol doesn't decrease. And when you're long a calendar spread, long a time spread, you're buying that Vega. So if the vol goes up, you make money on the change in vol. Okay, last call, guys, here. Last call. Okay. Any questions? Any questions? In fact, what I'll do real quickly here, guys, in on UNH. Okay. UNH, we put out a calendar call spread last week. We did that after earnings. Okay. So we didn't do it when the vol was up here. We did it after the earnings call was out, after the stock tanked, and vol dropped down to here. Okay, when vol is here, that is a wonderful, great time to put on a time spread. All right, everyone, smash that like button. Please, 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 please smash the like. Let's get that wheel up here. How are we looking on the wheel, Mike? Waiting for it to pop up here on my end. Oh, Randall, Ty, these are all recorded. If you go to our YouTube page for Prosper Market Minds, they're all up there. Every one of them is recorded. In fact, this is, if you go to our Market Minds YouTube page, you'll see them all listed here. Okay? Awesome. Awesome, awesome, awesome. All right, guys. Let's, pretty full, not closed yet. Come on, Mike. I need this wheel. Man, I guess this is a big wheel today, guys. It is a big, big wheel. And it is officially closed. I'm just waiting on it. Any other suggestions while I'm waiting? Any others? Here it is. Any other suggestions so we don't use Harpo anymore or Groucho? I am open to suggestions. We got the wheel. Oh, this is really full. Holy smacks. Wow, 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 wow. Okay. Okay. Let's give it a whirl here, guys. Let's give it a whirl. Here we go. Here we go. Today's winner. Who is it going to be? No way. Ty Hoffman, the guy that literally just recorded. Come on. And yes, Gary Garvin, thank you. 17 likes out of all these watchers. What the heck? Smash that like button, guys. Ty Hoffman in the house. Ty Hoffman, let's go. Let's go. Ty, send me an email. Right there. Send me an email right there with your name, mailing address, and size swag. All right? Awesome. I will be back on the floor tomorrow in the S&P 500 options pit, guys. Thank you very much for tuning in, everybody. It's a good time to be trading. Appreciate all of you. As always, have an awesome day. And if you have any suggestions to replace Groucho, and Harpo, send me an email. Thanks all. Have a great one.